Some of you may be familiar with a little thing called the yield curve. Well, I got news for you. It has officially uninverted. Let me go ahead and tell you why that's even worse than if it was to remain inverted for a little bit longer. We'll be breaking that down towards the end of the video, so stick around if you want to find out. We're also going to be talking a little bit about the upcoming employment report. What's up, apes? Welcome back to another edition of the Daily Peel's daily podcast of the day. Thank you all for joining us here once again on this beautiful Thursday, September 5th, 2024. It is currently 6:44 p.m. and we got a lot to talk about here today, so let's go ahead and get right into it. Some of you may be familiar with a little thing called the yield curve. Well, I got news for you. It has officially uninverted. Let me go ahead and tell you why that's even worse than if it was to remain inverted for a little bit longer. We'll be breaking that down towards the end of the video, so stick around if you want to find out. We're also going to be talking a little bit about the upcoming employment report. By the time you're watching this, the August jobs report probably will have dropped because it's going to be coming out at 8:30 a.m. tomorrow. And based on the time that I assume you fucking apes wake up in the morning, or more accurately, afternoon, it's probably dropped a couple hours ago. But we're going to get you prepared for that, give you all the context you need to understand that report in its entirety. Meanwhile, I'm going to be hoping that my shirt doesn't cause me to blend into this green screen for the video. Those of you watching on the video, if it does, that's pretty damn funny. So actually, maybe I do hope that it actually does. Then we're, of course, going to be talking about some big stock moves of the day. We got a major AI update from Tesla. And speaking of AI, the company whose ticker symbol is literally the letters AI is very much failing to live up to the name and all the hype behind the industry. All right. Starting off with the WSO Alpha portfolio. It's actually relatively good day for the fellas at WSO Alpha here today. We were up 17 basis points on the session. That was drastically outperforming the shitty little S&P 500 that managed to fall 30 basis points for the day. But we did slightly underperform the NASDAQ. The NASDAQ was up 25 bips. Once again, we were up 17 bips. So, about 8 bips of underperformance right there. Russell 2000 down 50 basis points for the day. Rough day for small cap stocks. Really, the main reason that we were able to lead so strongly was because of Tesla. Tesla was up 4.9% on the session, and we'll tell you why in just a couple of minutes. Before we get into that, we got a lot of banana bits to talk about here today. There was a lot going on in the world, guys. I don't make the rules. I am just your messenger, so don't get too mad at me. But the first and easily the most interesting thing that happened today, and I wish it happened earlier in the day because I totally would have written about that instead, but former President Donald Trump stood up at a meeting of the New York economic fucking losers or something like that. He was basically speaking at an economic forum in New York, and he laid out a whole bunch of different policy proposals, basically the equivalent of what Kamala Harris did in Durham, North Carolina a couple of weeks ago. He kind of went big, swinging on more, I don't want to say radical, but more out there ideas that the United States hasn't really proposed, talked about, considered, discussed, thought about beforehand. So some of our favorite ones included in the proposal were a 15% corporate tax rate for companies that make their products here in the United States. He's also shouting out the potential for an American sovereign wealth fund to invest in things like highway projects, food production, a bunch of other different things that should promote the general welfare, as it says in the U.S. Constitution, and of course hiring Elon Musk to lead a government efficiency commission. I don't know exactly how that would work, given that Musk is overseen by at least 3 federal agencies, so he could just cut all of their spending in theory and not be overseen by them anymore. But nonetheless, that is not my place. So, go ahead and read this Wall Street Journal piece because I promise you it's going to be more interesting than you already expect. Finally, we're also getting some ideas about how to regulate and how to register digital assets or cryptocurrencies with the Securities and Exchange Commission. One member of the SEC came out and basically proposed a whole new way, not stocks, not commodities, but a different category altogether for cryptocurrencies. And if these things are here to stick around, that's probably the best way to go about it. Meanwhile, a 10-person, 3-month-old artificial intelligence startup is currently valued at $5 billion. That is more than, actually, was it $5 billion or was it $10 billion? Yeah, it is $5 billion. So that is more valuable than Macy's. It's basically, here, let me go ahead and click on the piece so that I can tell you guys this. Basically, they have it at roughly the same valuation of Papa John's, Canada Goose, Bumble, Build-A-Bear, and Spirit Airlines combined. All of those add up to this 3-month-old 10-person company. It is called Safe Super Intelligence Incorporated. It's 𝗟𝗟𝗚𝗛𝗏, former member of OpenAI. Go ahead and check out all that stuff if you want to get the latest updates. Meanwhile, most people get divorced because of golf, but this divorce is happening in golf itself, I guess, or maybe because of golf or maybe because of a lack of golfing. But regardless, Topgolf and Callaway brands are planning a corporate divorce. These companies, they've been merged together for quite a long time now. Ultimately, they just came out with a release on Thursday and said, hey, we're going to have to call it splits because this isn't working out for shareholders anymore, and we all know that here in the United States, nothing matters more than shareholder value creation. So we're very glad to see that they are in the pursuit of achieving that goal. Finally, your dad's favorite computer company, maybe your grandfather's favorite computer company, HP, Hewlett-Packard, came out with a really, really shitty earnings report on the day. They did beat earnings, but early AI developments, early investment in artificial intelligence technology for the computer hardware company were eating into margins for the quarter. Investors didn't want to stick around and find out what's going to happen down the line, so they bailed out of it already. Shares were down pretty big on the day. All right, let's go ahead and move into our big story of the day. We are, of course, talking about the previews. It is that time of the month once again. Everyone else is losing their ever-loving minds over the NFL season starting in just a couple of hours from now. We got the I believe it's the Ravens and the Chiefs playing here tonight. I got Travis Kelce on my fantasy team going, but quite honestly, I'm not excited about it at all because my fantasy team looks like absolute garbage going into the year. That's what you get for being in a dog park when your draft starts and forgetting about the draft. And then auto-drafting the first 2 rounds, you just completely fuck yourself. So don't do what I did, even though it is too late for those fantasy drafts to be happening already. But somehow, the labor market going into the August jobs report coming out tomorrow is looking even worse than my fantasy team. So let's talk about the data and what got released today. So all week, the Bureau of Labor Statistics, Department of Labor, and ADP have been hyping everybody up, or the exact opposite of hyping everybody up, about the labor market and what's going to come in Friday's report for the month of August. So we start out with taking a look at ADP. This report dropped Wednesday morning. Basically, ADP, automated data processing, this is the largest payroll provider in the United States, and I believe the second largest in the entire world behind Alight. But ADP came out and they, because they have access to the private data, they can quantify total private payroll additions. They have a large enough data set where they can kind of extrapolate to the rest of the U.S. economy. And according to them, private employers in the United States added 99,000 jobs in the month of August. Now, 99,000 sounds like a lot. I mean, it's certainly a hell of a lot of problems to have, as Jay-Z so rightfully pointed out. But 99,000 job additions is also the single lowest amount of additions we've seen since January of 2021. So in more than 3 years, this is the lowest that we've seen so far. It's also well below the 111,000 downwardly revised additions from July and well below the 140,000 estimate that I guess economists were guesstimating. Who the fuck is paying these people to come out with estimates like this? Like, you might as well just have a child throw darts at a fucking dartboard and see what comes on there. But either way, clearly, the labor market's steroid regimen has been ended because it's nothing but weakness going forward. It was a very ugly report on the ADP side of things for a couple of sectors in particular as well. So we got sectors like professional and business services lost about 16,000 jobs, manufacturing lost 8,000 jobs, and information technology lost 4,000 jobs. But at the exact same time, every other sector that ADP tracks saw job gain. So this could be a more kind of nested sectoral labor market weakness that we're seeing right here. It might not be a huge problem for the economy as a whole. We'll find out tomorrow, but we do have more hints from the initial jobless claims data. So initial jobless claims, this is basically tracking claims for unemployment insurance that begin in the last week or so. This is a weekly measure. So what we're talking about here is from the period ending August 31st. And we actually did see a decline in the initial jobless claims, a decline of about 5,000 total jobless claims from 232,000 to 227,000 from the week prior to the week ended August 31st. Now, the estimates were for about 230K, so again, coming in below that as well. Now, if we look at the 4-week rolling average, which is really the important part of the initial jobless claims, we can see that that also declined by about 1,750 total claims. Now, obviously, that is not a big number at all, but it is moving in the right direction. Like we always say, it's not about levels, it's about the direction that it's going in. And so we're at least going in the right direction on the initial jobless claims side, which might make you feel good until you remember the JOLTS report came out this week as well. So the JOLTS report, this is Job Openings in Labor Turnover Survey, and this essentially seeks to measure changes in employment status for the United States labor market. So what we saw last month was job openings did decline slightly. It was honestly a very negligible decline from about 7.9 to 7.7 million. Really doesn't make a big difference at all. It might seem like a large number, but in the grand scheme of things, it doesn't really matter. What does matter, however, is that the job openings rate hit a fresh low at 4.6%. Job openings rate is basically just the total number of job openings divided by the sum of job openings along with total, the total number of employed people. So that rate hit a fresh low at 4.6%, definitely not something that we want to see. We also saw a spike in hires, which is actually good. You know, it shows that employers are willing to kind of take more people on. But at the exact same time, we saw basically an equal spike in separation. So it really just seems like those hirings are compensating for those quitters and those people who gave up on contributing to the U.S. economy. They're fucking dead to me if you quit your job. I don't care how much you hate it. Be an American and suffer through that shit for the next 40 years. Most importantly, however, the job openings to unemployed persons set a new low not seen since April of 2018 at about 1.07. So for every unemployed person in the United States, there is currently 1.07 job openings that they could apply for and potentially get. Now, being above 1 is actually more of an anomaly than anything in the last 20 years here in the United States, but it's not about, all of history. It's about relative to recent history, like everybody's favorite Jeopardy category. It's all relative. Like we said earlier, it's never about, the level. It's never about good or bad. It's all about better or worse. And this is absolutely getting worse. It just has been getting worse and worse since about the end of 2021. So somehow the Federal Reserve has had their blinders on, their ears plugged, like that fucking monkey that looks like this that you always see in those like tacky little gift shops when you're on vacation in the middle of buttfuck nowhere or something. That is effectively what the Federal Reserve has been. And so at this point, the labor market has become kind of like the new Osama bin Laden in the sense that it's enemy number one here in the United States. We'll get the official confirmation later on today if that's the case, if it's, on the terrorist watch list as it should be, because I consider weak labor market data an act of terror. I don't know if the Justice Department does as well, but I'll definitely be lobbying them to do so. But nonetheless, this is just another example of the Fed fucking up. Now, the thing is, the Federal Reserve, J-Pow's Fed, this has kind of been their MO. They're late to the game. They wait until all the data comes in, and then they make quick, fast decisions. So they've been late on things, but they act very quickly. Quite honestly, obviously, you gotta punish them a little bit for being very late to everything. So they certainly do deserve some criticism. But despite this lateness, the outcomes really haven't been that bad. Think about it. Since 2018, we've seen inflation got a little bit ridiculous. I will give you guys that. Everybody's still fucking complaining about it so much, mostly because of grocery prices. But overall, really, the policy responses and the economic outcomes that it's created haven't been as bad as they possibly could be, despite this lateness. But nevertheless, that can always change going forward. They've clearly waited way too long before easing monetary policy. We've known that the labor market has been weakening since back in, winter of this year. Like, we could tell this was happening back in March, quite honestly, with unemployment data stemming all the way back then. So once again, Powell gets absolutely no credit. Powell gets credit if we go into a recession. We can absolutely blame him for being late to the game. If we don't go into a recession, I don't know if he gets credit for that or if it's just more kind of right place, right time. You guys can ultimately make the decision right there. But clearly, an overly nerdy reliance on data is becoming a big problem at the Federal Reserve. I personally nominate David Solomon, Mr. DJ D. Sol, to be the next Fed chair, because to be a DJ requires a little bit of an ability to read the vibe rather than, reading the data, or alternatively, just go to my favorite data source and just fucking make shit up. Okay, let's go ahead and move into some of our big stock movers of the day. First and foremost, we have G3 Apparel Group. I had never heard of this company before either, but apparently this is the holdco behind brands like Calvin Klein, DKNY, what's that other one that I wear all the time? Nautica is a good one as well. They own all of these different clothing brands, and somehow they managed to actually have a good earnings report despite recent pullbacks in apparel spending. Apparently, consumers still like to not be naked, and especially with G3 Apparel's brands on them. So sales came in at about $644.8 million, roughly $5 million short of estimates, but still nobody cared because earnings nearly doubled estimates at 52 cents per share, whereas consensus was looking for about 27 cents per share. So that's a 47% beat right there, because this was an absolute masterclass in inventory management. Total inventories levels fell 24%. No write-downs or anything like that, hurting the bottom line like we've seen at a whole lot of other companies, and like really blew up in Target's face last summer back in 2023. They also raised guidance for net income by about 5.8% to $182.5 million for the remainder of the fiscal year. Shout out to G3 Apparel Group. Moving on down into Tesla, up 4.9% for the session. Elon and the European Union, these guys have more beef than fucking Kendrick and Drake, then Bill Ackman and plagiarism, then, me and the sweat stains that are forming under my shirt as I speak. But nonetheless, Tesla decided, fuck it, let's go for it, and they decided they are going to be releasing full self-driving, the latest version of FSD in Europe as early as the first quarter of 2025. Now, they also announced the same thing is going to be going on in China, pending regulatory approval in both regions, but still, this got investors very fired up about the potential for artificial intelligence, especially when applied in self-driving. Now, this comes just one day after Tesla got the boys fired up over the potential for robots to come in and take everybody's job so that we can live our dreams of making the movie WALL-E in actual reality. So this got investors even more fired up about the technological capabilities of this company. Maybe Cathie Wood's price target isn't as completely fucking ridiculous as we think. Just kidding. You would have to be absolutely hammered to think that that's the case. But still, shares up 4.9% on some more hype around the tech side of things. I'm surprised it didn't fall, given that Elon has basically said over and over again, I would love to go and serve in a Trump administration, which almost definitely means that he would have to step down as CEO. If not, that's a huge conflict of interest. If Tesla loses Elon, I mean, what happened when Apple lost Steve Jobs? What happened when Amazon lost Bezos? I mean, actually, I don't think they suffered too badly after losing Bezos, but still, definitely would not be a pretty picture for at least the short term after that. Okay, moving into our What's Rotten movers of the day, we first and foremost have Frontier Communications. And personally, I don't blame Frontier Communications for selling off 9.5% on the day either. I probably would have been feeling way more down than that if I found out that I had to work with Verizon going forward as well. And that's exactly what happened to this poor, sweet communications company. They are being acquired by America's least favorite brand. Verizon is buying Frontier Communications for $20 billion in an all-cash deal at $38.50 per share, roughly a 44% premium to the 90-day volume-weighted average price of Frontier Communications stock. So it's 44% premium. Investors are pissed about it on both sides of the acquisition because one, analysts have basically been identifying a handful of problems. One of the big issues is that Frontier Communications are a fiber optic networks provider, and Verizon is looking to expand its presence into that industry a little bit more. But according to analysts, Frontier doesn't have the fiber necessary for that to become a tangible impact on Verizon. Verizon being a huge company, Frontier being much smaller, doesn't necessarily bring the weight that would be needed to, move the line on Verizon's bottom or top line. That was the other thing. This other analyst cited that this has the potential to cause earnings per share at Verizon to decrease, at least in the short term, and the same thing for free cash flow. So they see this as very dilutive, very non-accretive to the overall company. So really, everybody was upset about this, but apparently Verizon is still going for it. All right, our last stock mover of the day, we have C3AI down 8.2%. I really think the most valuable thing about this company is its ticker symbol. Its ticker symbol are just the letters AI. And how they got that, I have absolutely no idea. I'm sure that's something that NVIDIA or Elon Musk would pay billions of dollars in order to have. Actually, maybe United States Steel Corp has the best ticker in the country because theirs is just X, and we know that Elon Musk would go fucking bonkers if he got just the X symbol. SpaceX, X formerly known as Twitter would probably be public again already if he actually had that ticker symbol. But nonetheless, C3AI reported earnings that tanked shares down about 8.2% for the session. They did report relatively good earnings, though. They lost only 5 cents per share on the quarter on 87.2 million in total sales. Estimates had them coming in at a loss of 13 cents per share on $86.9 million in total sales. However, the outlook was weak, and the split between recurring revenue and just kind of one-time earned revenue is getting a little bit weaker for analysts. So analysts had been looking for roughly a 90% recurring revenue rate, but it actually came in at about 84%. So that means 84% of C3AI's revenue comes from subscription-based customers. The market was looking for closer to 90%. At the same time, C3AI dared to give revenue guidance for the next quarter that came right in line with estimates at $91.1 million. When you're in the artificial intelligence game, if you're coming in line with estimates, you are missing. So the stock is down 8.2% on the session. All right, finally, our thought banana of the day, our last story to discuss. This is the UNO reverse card yield curve. That's what we're talking about right here. We all know bad omens in society. For example, red moons, black cats, broken mirrors, waking up in the morning. All of these are very bad signs of what is to come, but none are more infamous than the yield curve. And why is that? Well, because the yield curve relates directly to shareholder value creation and more specifically destruction. And obviously, that's the most important thing going on here in the United States. So What's going on? The yield curve, basically all that the yield curve is basically a line chart that plots the yield of fixed income assets, from a given issuer across different maturity timelines. So the y-axis is the yield and the x-axis is the maturity timeline. So here is, 3 months, 6 months, 1 year, 2 years, 30 years, all the way out. And it should look like this. It should be sloping upwards because as you invest in assets that are more longer dated before the payoff actually comes, you're taking more risks simply by owning these things for longer. Think about, inflation rising over that time period. Think about an asteroid potentially coming and hitting the Earth. So you deserve to get paid for some additional risk so that when longer dated yields fall below that of shorter dated yields, technically that is an inversion. But, more specifically, when anybody talks about the yield curve to you, they're probably talking about the US Treasury and the yield curve of Treasury bills, notes, and bonds. And now, when they talk about yield curve inversions, typically 90% of the time they're going to be talking about the 10-year and the 2-year yield. If they know what they're talking about, on the off chance that remaining 10%, they're going to be talking about the 10-year and the 3-year yield, because that is the actual inversion that matters, according to 𝗥𝗢𝗟𝗘, the guy who actually created the yield curve inversion. But nonetheless, the yield curve has been inverted since it first went into inversion in April 2022, and then it landed back in inversion and maintained that in July 2022 through to Thursday of last week. On August 30th, the yield curve uninverted for the first time in more than 2 years, the single longest continual stretch of inversion that the American economy has ever seen. Now, on Thursday, the yield curve uninverted. It then inverted again on Friday, only to then remain inverted on, through Labor Day and on Tuesday. Then on Wednesday, it re-uninverted. And yes, re-uninverted. And then earlier today, it did invert once again. So it's becoming a little bit volatile. It's changing up. It's becoming very flip-floppy. Kind of imagine the yield curve as Kamala Harris's voice, depending on what audience she's speaking to. It's going to change up quite a bit. And that's exactly what we're seeing right now. But you might think, David, the yield curve inversion, doesn't that project a recession within the next 18 months or so? Well, yes, it absolutely does. The yield curve has projected 11 of the past 7 recessions, is the often quoted saying, or 9 of the last 5 recessions or so, because when the yield curve inverts, it tends to do a good job of predicting economic volatility going forward. A lot of people interpret it as meaning, there's definitely a recession on the way. Historically, that's not what the data actually bears out, but still, it is a pretty damn good indicator for a looming recession. But what's an even better indicator for a looming recession is an uninverting yield curve. And the reason that is because when the yield curve is uninverting, what must be happening? Well, either short-term rates are rising or long-term yields are, short-term rates are falling or long-term yields are rising. That's the only way that you can get that kind of leveling out. What's happening right now is that we're seeing a sharp decline in short-term yields because the Federal Reserve is about to cut interest rates, so traders are betting on yields going lower. They are buying up short-dated Treasury bonds to get the kind of existing higher yield right now when they know that new issuance is going to be lower going forward. So that buying pressure is pulling yields downward. And what does that do? Well, not really anything, but what it signals is that, basically the interpretation would be, why is the Federal Reserve cutting rates? Why are investors betting on yields going lower? Well, because the Federal Reserve is going to be cutting rates because we see a recession on the horizon. So this is one of those things that in economics, it actually does make, intuitive sense. When we see the yield curve uninvert, it's typically because short-term yields are falling because there is a rate cut on the way. Why else would there be a rate cut on the way other than to protect the U.S. economy from a recession? All right, that about does it for us here today. We'll leave you guys with our quote of the day from Mr. Baron Rothschild, the original controller of the weather, I'm pretty sure, is what I've been told. He came out here at one point and said, "Buy when there's blood in the streets, even if the blood is your own." Keep this in mind as we go into some periods of economic and market volatility, almost definitely going forward. Realistically, we're always in a period of economic and market volatility, so don't let it scare you out of investing. Don't let this sell your entire portfolio. Stay the course, figure it out, don't take too much risk, and most of all, happy investing, happy trading, and we'll see you guys tomorrow. Bye now.